The headline is, I'm reading the tweet, Ripple sales of XRP do not constitute offer of investment contracts, according to Judge. They won. This is a huge vindication for them. And the XRP is ripping 35%.
Yeah. And it really handcuffs the SEC. What are they going to do about Coinbase and every other exchange? I mean, if they're not selling securities, I think Coinbase and everybody else has always maintained they're selling tokens. This was the fulcrum argument for the SEC, and they just lost.
The whole crypto market is ripping right now.
Following a monumental legal battle, Ripple Labs, the company behind the XRP token, secured a partial victory against the U.S. Securities and Exchange Commission. In the 2020 civil lawsuit, the SEC accused Ripple Labs of violating federal securities laws by selling XRP cryptocurrency to retail consumers. However, the U.S. Southern District Court of New York ruled otherwise, stating that certain sales and distributions of XRP tokens by Ripple and its executives were not investment contracts, and thus did not break securities laws. Nevertheless, the judge also ruled that institutional sales of XRP to hedge funds and similar entities are considered securities. Cryptocurrency investors embraced the news that token sales on exchanges are not investment contracts, considering the past chaotic months with U.S. regulators classifying most cryptocurrency tokens as unregistered securities. Experts, including former SEC official Christian Schultz, viewed the ruling as a win for the crypto industry, affirming that XRP is not a security and transactions in XRP on the secondary market do not violate securities laws. Billionaire investor Chamath Palihapitiya and members of the All In podcast also reacted to the news, believing it to be a significant victory for the entire cryptocurrency industry, which could impact the SEC's cases against Coinbase and other crypto-related firms. In the podcast, they also discussed the macro picture in the United States, including the likelihood of higher interest rates for a longer period.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
I just texted with Brad Garlinghouse, and he says, yes, it does mean that they won. And he feels
vindicated
and really happy. It's a judgment that seems to indicate for a lot of folks that these are not going to be treated as securities. I think that this is a really important, just think about how amazing the United States is, that the government agencies, the administration in power, can come after corporations. And then we have a court system that can adjudicate and make decisions that follow the rule of law. I know we're going to talk about Lina Khan and her agency's efforts at litigation, but I'm really encouraged at the fact that the court system in the United States doesn't just kowtow to whatever administration is in power at that moment, that they do adjudicate by the law and ultimately provide greater clarity for business, for individuals to operate going forward. That there is a better sense now for the market. There's a better sense now for individuals. Great is that there's now clarity because the courts provided that. Yeah.
Has this trend changed? I thought America always did that.
Yeah, I think it's great. I think it's, look, because you obviously have a very zealous administration and a very zealous agency leader who is testing the boundaries. And, Lina Khan's agency is pushing the limits on what constitutes antitrust. And in the effort to try and push those boundaries, there is a pushback from the courts.
No, but in crypto, it's been Gensler in the SEC.
And it's been Gensler in the SEC. I'm sorry. I'm talking, but both agencies, right? And so it's good to see that there's clarity emerging and that the courts do their job.
The big news this week is inflation has eased to 3% in June. So the Fed's increases have worked. And I guess the question now is, are we going to have a sustained high interest rate, or is it going to get cut slowly?
I think Larry said publicly that he thinks that rates are going to need to be higher for longer than what the market is currently showing. We talked last week with Brad, obviously, about what the market is showing rates to be, and he's assuming some rate cuts will start to happen in December, and that's really what the market is saying is going to happen. And Brad's point was the market knows better than the forecasters. But Larry Summers has publicly shared that he thinks that is actually not correct. And, again, diversity of views is important to understand, that there are structural things that are happening in the world right now, including a decoupling from China, which is inflationary because, China provides cheap goods and cheap manufacturing for a lot of industries, and many of those industries sell to consumers. So ultimately, those prices are going to show up in consumer costs. There's an increase in energy transition expenditure and security globally. And Summers has pointed out that those are not free. They have to be funded. And obviously taking on more funding means you're going to have to pay higher interest rates for investors to provide that capital. to do that funding. So there are more structural, longer term trends that some folks in the Summers camp have been arguing are going to be driving inflation higher and keep rates higher for much longer than what the market is currently showing. And I think it's really worth noting that point of view, particularly given how quickly the market thinks rates are going to start getting cut.
The more important thing from that, JCal, is so what do we do about it? And I think the most important point of view that I'm trying to get to is where do I think the equity market is going to go? And, all roads, at least right now, look like the market is getting set to go materially higher. And the reason isn't whether, terminal rates are at 2% or 3% or 3.5%. I don't think that matters that much. What matters more are the trillions of dollars that are sitting on the sideline or in other defensive assets that need to then pivot around and get put back into growth assets once you know that the worst is behind us. And I think that's what a market always looks for before real sentiment changes. And what's important to note is that by the time most people figure out that the sentiment has changed, it's already actually too late. And so I think right now in the next sort of like 12 to 18 months is really when the bottom is put into the market. It's before the Fed starts cutting. It's when rates are still going to be relatively high, but the really astute sharp in this market will get ahead of it and they will start to buy what they think will be an eventual rally.
Chamath Palihapitiya is among several renowned investors predicting more upside rallies in the stock market, even in the face of gloomy economic conditions. The possibility of a soft landing rather than a recession, along with the AI hype, is expected to support higher stock prices regardless of the overall economic outlook. However, David Sachs disagrees with Chamath's prediction and attributes the rallies to the market's expectation of rate cuts, possibly happening early next year, if interest rates stay high until then. Sachs believes that if interest rates remain elevated, the chances of further stock market rallies will be slim. Here are more clips featuring insights from Chamath, Sachs, and Friedberg.
So I think that Larry is right. I think that I still believe what I've said for a while, which is rates will be higher for longer. But what I didn't believe before was that the market was set to go up. I think we did a great job. I think literally that when I made that comment November of 21 about starting to sell, it was the absolute top of the market.
Yeah, you nailed that one.
Nailed it.
Yeah.
And I think my commentary now is that we're putting in the bottom. And I think the market is set to go materially higher, even if rates are persistently higher for a while.
I don't think it's going to be a mania, but I do think that the market is ripping today because the market is basically pricing in the idea of a soft landing along with inflation being tamed. So you had a positive CPI report at 3%. You had a hot jobs report a week or two ago. And there's an interesting article in the Wall Street Journal today talking about the odds of a soft landing improving. And they have some data for that. I don't particularly agree with the subheadline. They're trying to...
Latest data suggests a lot of past inflation was transitory. That seems...
Yeah, that I think is being too charitable to the Fed because when they use the word transitory, they were using it as an excuse not to raise interest rates. And we just had the fastest rate tightening cycle ever over the past year. That's the reason why inflation has gone down. It was not transitory until they jacked up interest rates from 0 to 5%. So the Wall Street Journal, I think, is doing a little covering for the Fed there. But nonetheless, I think everybody is pleasantly surprised that A, CPI is now down to 3%, and B, you have not had a significant cooling of the jobs market. So certainly the odds now of a soft landing have gone up. And the thing that's sort of surprising about what Larry Summers is saying is that if you believe that inflation is going to come roaring back, that's certainly a contrarian bet. That's not what the market is saying right now. What the market is predicting right now, and the reason why stocks are rallying is what the market is thinking is, well, if inflation is down to 3% and we can end the year at 3 or even lower, then the Fed can start cutting next year. And so they're starting to price in rate cuts. But if inflation comes roaring back, you're not going to get rate cuts. And so stock prices are going to go down. I don't see how you can have a scenario of even higher interest rates from here along with higher stock prices. I think you need lower rates to get higher stock prices. So basically, if interest rates go down, I think for sure you'll see multiples go up. But I think if interest rates are going to keep going up from here, then you're not going to get that rally.
I think there's a general statement that can be made that we are coming out of a zero interest rate environment into which lasted for a very long period of time into a very stimulatory environment because of government spending. And when you have government spending stimulating the economy, you have a natural market force of inflation coming from the additional capital being pumped into the economy and the purchasing and all that sort of stuff. Like you pointed out, 50-year low in unemployment, and we're trying to create a bunch of new jobs. And who's going to fill those jobs? You're going to have to pay people more to get them to take those jobs. So, you're going to see a rise in wages. It drives wage growth, but ultimately, keep this in mind. So the lower wage workers, let's use a simple example, people that work in fast food, if their rates go from, $8 to $15 to $25 an hour, the cost of fast food goes up. So on the food price index, you'll see a rise in food prices. So right now, it seems like the Fed and the market are all acknowledging and reacting to, these I would kind of argue acute conditions that are being resolved from coming out of the COVID stimulation. But there are in place, as the comments have been made, increased spending to NATO because of global security concerns, increased defense spending globally. The current projection from the CBO showing what defense spending is going to be as a percentage of GDP or a percentage of government spending. There are some folks, as you guys all know well, who you would speak to in DC, who think that those numbers are BS because we're going to increase defense spending, not cut it, because of global security concerns, particularly as we decouple from China. And all of the energy transition stuff, the IRA, the CHIPS Act, which is a security thing, these are all stimulatory. So the tides come in and out, but the sea levels are rising. And over time, that translates into a way to manage the inflation, but also to raise the capital, which means you have to pay higher rates. And this is in the EU and the US that it seems this is going to be the case.
Expert analysts and top investors often hold contrasting views on the state and trajectory of the economy. However, there is widespread agreement that the U.S. economy faces numerous macro headwinds in the foreseeable future. Many are concerned about the potential return of a banking crisis, given the brewing commercial real estate crisis unfolding in the coming weeks and months. Moreover, the rapidly increasing debt-to-GDP ratio and rising interest rates are additional challenges the U.S. economy must confront in the long term. The video presents a carefully laid out analysis of the current state and trajectory of the U.S. economy. As viewers, we are encouraged to share our thoughts and observations in the comments section below. For more Daily Dose Crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.